Welcome to the Pro Ticker Deep Dive. Our mission today, well, it's really to look right past all the political noise that's been dominating the headlines. We want to dive deep into this quiet recalibration happening in the Eurozone bond market. And we're essentially hunting for where fiscal discipline actually resides right now. And the core question for this deep dive, it's simple, really, but it has some major implications for portfolios. What happens when a big economy like France, seen as core, starts to wobble a bit, while a quieter neighbor, way up north, decides to aggressively tighten its own belt? Yeah, for weeks, everyone was just fixated on the political drama in Paris, right? The no-confidence votes, the government surviving. But underneath all that, the bond market was quietly setting up this fascinating relative value story. It's pitting the, well, still fragile fiscal outlook of France against the disciplined rise of Finland. This is where the smart money seems to be positioning itself now, moving away from broad market timing maybe towards more surgical bets based on, national fiscal credibility.
That shift is absolutely critical. You've hit the nail on the head there. For a decade, investors kind of assumed the ECB would backstop almost anything in the Eurozone periphery. That era, it's over. Now, the market isn't really betting on the ECB in the same way. It's making very selective choices. And those choices are based almost entirely on which government seems to have the political will, the grit, to push through sometimes painful long-term reforms. We're back to granular national credit risk analysis. It's fascinating.
Okay, so let's unpack the French situation first then. Their prime minister survived those two no-confidence votes recently. That seemed to stabilize things politically, at least enough for the 2026 budget talks to sort of resume. Politically, yeah, sounds like a win. They avoided a snap election. But if we strip away the political theater, what's the actual economic reality they're dealing with? What's the backdrop?
It was really just a temporary political pause. Nothing more fundamental has changed. Economically, the headwinds are, well, they're substantial, and they seem to be growing. We saw growth slow to a really sluggish midder 0.3% in the second quarter. And worse, if you look at forward indicators like retail sales, they're basically stagnant. The French consumer, who's supposed to be the engine, they're just extremely cautious right now.
That's the bit that keeps confusing people, I think. Our data shows inflation is pretty low, maybe 1.2% year over year, and real incomes are actually going up because prices aren't rising as fast. So why are French households holding back? It seems totally counterintuitive, doesn't it? With more spending power, you'd expect, well, more spending.
It points directly to some serious consumer confidence issues and maybe a kind of structural anxiety. French households are saving a lot. We've seen the savings rate climb significantly, while actual consumption just flatlined. This isn't just general caution. You could argue it's uncertainty linked to future government stability, the long-term social contract, maybe.
Are you suggesting this anxiety is connected to those earlier political fights? Things like the pension reform battles, because those were hugely contentious. And now they've basically been put on ice because of the political instability.
Precisely. Think about it. If you're a French worker and you've watched the government really struggle, maybe fail, to implement unpopular but possibly necessary reforms like pensions, you start to question if the whole system is sustainable long term. So what do? You save more, you hold back on big purchases. That kind of behavioral anxiety creates a real drag on future demand, even if your real income is technically rising. And on top of that, the labor market, which had been a real source of strength for years, it's stalled out, job growth has stopped, and unemployment is kind of nudging back up towards 7.5%.
Right. And this consumer hesitation, it feeds directly back into their deficit problem, doesn't it?
Yeah.
Paris had this goal, aiming to narrow the budget deficit to 4.7% next year, trying to show Brussels they were being responsible. But the political reality they face now, needing to keep various groups happy after almost falling, it might mean they're forced into a compromise closer to 5%.
Yeah, and that difference, 0.3%, going from 4.7% to 5.0%, might seem small, but it sends a really negative signal. A signal about lack of control, maybe. Combine that expected slippage with rising interest costs on their huge pile of existing debt, plus the cost of not doing reforms, well, the long-term fiscal picture stays perpetually cloudy, and investors really don't like perpetually cloudy.
Okay, so here's where the market delivers its verdict, right?
Okay.
Cutting through all the political speeches, we see it clearly in the yield gap between French government bonds, OATs, and German bonds, the Eurozone benchmark.
Exactly. That spread is the market demanding a risk premium. Plain and simple, it's widened out quite a bit, hitting roughly 80 basis points. That's the highest level we've seen in over a year now.
Now, 80 basis points, I want to push back on that a little. You mentioned earlier, back in the 2011 crisis, Italy, Spain, spreads were exploding past 250 basis points then. So if 80 is historically kind of mild compared to that, why all the concern about this level today? Is it really a big deal?
That's a really key distinction. No, 80 basis points is definitely not a crisis level like 2011, but it is a significant psychological and structural barrier in today's context. In this environment, it puts France uncomfortably close to potential negative actions from rating agencies. They're much more sensitive now to countries persistently running deficits above the EU thresholds. So breaching that 75, 80 basis point range, it signals that the underlying fiscal divergence between France and Germany is becoming more ingrained, hardening perhaps, and that means investors demand more compensation, not just for immediate panic, but for future uncertainty.
Okay, so if this spread keeps drifting up, say towards 85, maybe 90 basis points, what happens then? Does the European Central Bank step in? Do they try to calm French debt worries like they did for the periphery countries a decade ago?
Highly unlikely. Not in this scenario. The ECB has its tool, the Transmission Protection Instrument, the TPI. It's specifically designed to prevent unwarranted, disorderly market dynamics that could mess up monetary policy transmission. But the key word there is unwarranted, France's situation. You could argue it's warranted. This isn't some sudden liquidity panic hitting an otherwise sound borrower. It's investors methodically pricing in long-term solvency risk. Why? Because there's a perceived refusal or inability to implement necessary long-term reforms. The ECB is not going to use the TPI to bail out governments that won't take fiscally responsible actions. They'd likely see the spread widening as a market signal for Paris, a signal to get its house in order. So yeah, 80 basis points might feel uncomfortable for France, but it's arguably the justified premium for not tackling those structural debt problems head on.
Right. So if the ECB safety net isn't going to catch the big players unless things get truly apocalyptic, investors have to look elsewhere within the Eurozone for stability anchors. Which brings us directly north, away from Paris, to our alternative story. Okay, so while the world's financial media has been glued to the drama in Paris, Finland, way up north, is quietly emerging as this genuinely disciplined outperformer.
Yeah.
What's driving this radical pivot to prudence in Helsinki?
It really boils down to political commitment translating into hard numbers. Unlike France, Finland had a change in government, and the new coalition came in with a very specific focus: fiscal consolidation, austerity even. Their draft budget for 2026, it shows a real determination to cut spending and slash that deficit significantly. We're seeing a concrete plan. Cut the deficit from 4.3% down to 3.6% in 2026, and they have an even more ambitious target after that, getting the shortfall down to 2.5% by 2027, plus long-term plans to get debt back towards that 60% of GDP benchmark. This isn't just talk. These are actual policy changes, many of them unpopular domestically, being put into action now.
Those are incredibly serious targets, especially in what's likely still a low-growth environment for Europe. How does that discipline stack up against other northern peers, countries usually seen as stable?
The contrast is quite striking, and that's really the core of the relative value trait here. You look at Austria, for example. Their deficit is still projected above 4%. The Netherlands, another northern core country, they're actually projecting a rising deficit for 2026. So Finland, by choosing this path of immediate, pretty aggressive tightening, is really standing out. It's becoming the disciplined option, maybe the true safe harbor in the northern Eurozone right now.
Which leads us straight to the opportunity then. In relative terms, if you're an investor looking for stability, looking for fiscal credibility, Finnish government bonds suddenly look, well, materially undervalued compared to those peers, don't they? It means you might find stability without paying the high price for German bonds.
Absolutely. And we're seeing demand pick up significantly because of this. That demand seems particularly focused on their upcoming tap auctions, especially in the 7-year and 10-year parts of the curve. If you look at the charts, technically, Finnish bonds have been building a base relative to their peers since late summer. It suggests the market is already starting to price in this turnaround story. And critically, look at supply dynamics too. Finland is keeping new issuance relatively limited. Compare that to the higher supply expected from both Austria and the Netherlands. Limited supply plus aggressive fiscal consolidation. The technicals really support a price tightening for Finnish bonds.
Okay, so let's try and synthesize this, pull it all together for positioning.
Yeah, if we synthesize this shift, the main strategy in Eurozone fixed income right now, it's undeniably a relative value game. The ideal positioning seems pretty clear. You'd want to be long Finland relative to those weaker fiscally expanding peers, think Austria, maybe the Netherlands. You have to remain cautious, maybe underweight on France until they demonstrate some credible reform action, and probably stay neutral on core Germany, given the already tight spreads there.
Okay, so beyond that core long Finland idea, are there other key opportunities cropping up because of this renewed focus on national credit differences?
We are seeing some interesting dynamics. For example, spread compression between covered bonds and supranational agencies, SSAs, that's likely to continue.
Hold on, just quickly. SSAs, you mean things like the European Investment Bank, EU bonds, that kind of thing.
Exactly. Supranational agencies, generally seen as very safe.
And compression means the yield gap is shrinking. They're becoming, relatively speaking, less risky or perhaps more fairly valued compared to other safe-ish debt.
Precisely. SSAs are top-rated, very secure. In this kind of environment, this flight to credibility, they look increasingly attractive. The compression is happening because the market's realizing these ultra-safe instruments are currently offering a small yield pickup compared to some underlying government debt, which perhaps they shouldn't be. It's an appealing niche for certain credit investors. And there's also a potential currency angle. With this fiscal divergence growing in Europe, some models are suggesting the EURUSD cross could strengthen, maybe approach 1.23. A stronger euro generally makes euro-denominated fixed income assets more attractive to global buyers, so that could add another layer of underlying demand.
That sounds like a fairly positive setup. But we know this market is heavily influenced by political risk. What are the key risks we need to keep an eye on? What could derail this whole relative value thesis?
Good question. There are three primary risks, I'd say. First, and probably foremost, political relapse in France. Any renewed instability there, maybe an unexpected snap election that forces more spending promises, that could cause OAT bond spreads to widen sharply again. And that kind of negativity tends to spill over quickly across the Eurozone. Second risk. We have to watch for ECB complacency. If they somehow signal they're underestimating France's long-term debt issues, or if they seem too relaxed about potential fiscal contagion, that could undermine confidence and lead to a sudden, more disorderly widening across the entire market. They really need to maintain that frame stance on the TPI, only being for unwarranted stress.
Okay, and what about Finland? That aggressive fiscal tightening, surely that carries its own risks, particularly for their economy.
Absolutely. That's the third key risk. Finland's own potential growth drag. Fiscal tightening is great for the debt numbers, great for credibility, but it fundamentally involves taking money out of the economy in the short term. That will inevitably dampen domestic demand. It will cap near-term economic growth. So investors need to understand that the potential return from Finnish bonds right now comes primarily from that stability premium and potential price appreciation due to spread tightening, not from a booming Finnish economy. And just from a technical trading perspective, everyone's laser focused on that OAT bond spread level. We see pretty heavy resistance, technically around the 85 basis point mark, and maybe some psychological support down near 70 basis points. If that spread pushes decisively past 85 basis points and there's no clear signal from Paris about budget reforms or any comforting noises from the ECB, well, that could trigger a fresh wave of selling, especially for more leveraged accounts.
So this deep dive really highlights that Europe's bond market, maybe more than ever, is fundamentally about credibility. Fiscal credibility, political credibility, structural credibility. France, it seems, managed to dodge an immediate political crisis, but they haven't really solved those nagging, long-term structural debt problems.
That's the core issue.
Whereas Finland, maybe unexpectedly, is demonstrating that old-fashioned, sometimes painful fiscal prudence. It still counts for a whole lot in the market's eyes.
It really does. Credibility is king when central bank backstops become less certain.
We've seen today how markets demand a very real, quantifiable premium when countries appear unwilling or unable to undertake those difficult long-term reforms. So the question we leave you with is this. What other quiet corners of the global fixed income landscape, maybe in emerging markets, maybe elsewhere in developed Europe, are currently being overlooked? Overlooked because of louder, more dramatic political noise somewhere else. Where is that hidden discipline, that overlooked credibility, located today? Something to think about. See you all in the next Pro Ticker Deep Dive.